Hello and welcome to a brand new edition of Inside Out on the Road, a show where we focus on individual stocks with in-depth analysis, deep dive into the financials and tell you about the key risks and triggers going forward. So let's not waste any time and get to our first stock today. My colleague Nigel gets us this very special deep dive on CMS Info Systems.
Inside Out on the Road is at CMS Info Systems to understand their business, how it's shaping up in a world gripped by digital payments. But before we get to that, let's explain the company to you. Well, they manage the entire flow and management of money from when the RBI initially deposits cash in the bank's currency chest to when the cash is deposited back in banks after going through the various stages of cash cycle. Now, the total number of ATMs in India is around 2.6 lakh, of which 1.5 lakh ATMs are outsourced by banks, and CMS Cash Management Business services 47% market share of the total number of outsourced banks. It has two key verticals, one being the cash management network, which includes ATM cash management, which used to be their sole business, but now they have widened their horizon. Well, this includes cassette management, ATM replenishment, day-end reporting, and reconciliation. They also partner with banks to offer cash management solutions to retail merchant networks, which ultimately helps in superior working capital as well as they interconnect bank branches. The second part of their business is the managed services and tech solutions business, which includes multiple offerings, be it automation, software, and AIoT remote monitoring. In the past 5 years, the revenues have nearly doubled. The margins as well have improved to the late 20s. Additionally, the company's dividend payout ratio, well, it's very healthy. The growth driver has been the managed services and tech solutions business. It contributes 30% of revenues. Earlier, it used to contribute only around 17%. The margins out here are relatively lower. Well, the company has laid out the near-term guidance of clocking revenues of 2,500 crores and then moving to around 3,500 crores. Since they're sitting on cash of around 450 crores, it remains to be seen how much of this is inorganic in nature. On the ratios front as well, things look pretty good. Well, the growth drivers include increase in the total business touch points as well as expanding their market share. Remember, formalization of the economy, well, that will be a tailwind for them as well. On the valuations front, the stock trades at around 13 times earnings, which looks pretty attractive, but there's a terminal value risk as it deals with cash. Additionally, there's a supply overhang because the promoter, Bearings PE, has been selling in the open market. Well, let's understand more about the company. Let's go across to Mr. Rajiv Kaul. Well, Rajiv, thanks so much for speaking to us here on CNBC-TV18 on Inside Out. Well, for a business like yours, with the emergence of UPI, one would have thought a cash management company will struggle. But your growth numbers clearly don't indicate that. In fact, you have grown very, very well. Do you think that cash, digital, both of them can coexist?
Well, thank you, Nigel, for having us on the show. CMS is no longer a cash management company. We were a cash management company in 2013-14. We have broadened ourselves into a far broader business services outsourcing company, primarily focusing on BFSI. And I've said this before in our quarterly calls, as India grows, as India banks help lead the growth, they will need strong partners like CMS to help them enable growth in terms of access to the last mile, technology offerings, and a logistics network which can help them deliver financial inclusion at a high quality and the lowest price. That's been our business model till now, and as you know, our company has transformed itself over the last 14 years. We feel, the fact that cash and digital have already proven themselves to coexist. We also know that, as the overall tide in India grows up and India growth story remains consistently strong for the coming decade, both UPI, digital, cash have their own growth levers. In fact, UPI growth gets misunderstood at times, because UPI growth has come at both, conversion of cash to UPI, but also other digital forms of commerce into UPI.
Let's get to a couple of numbers.
Sure.
In terms of touch points, on the banking side, well, you'll have majority of the market share. But tell us about the other opportunity, that's retail and other verticals as well. How do you see that panning out going ahead?
It's a great question. We have roughly 125,000 touch points today. They have grown at a CAGR of 10% over the last 4 to 5 years, despite COVID. We like to think that our business is linked to two big growth drivers. One is banks, as they grow, will outsource more. And second is, post-GST, we've seen a tremendous shift to the organized sector. Right. Unorganized to semi-organized, semi-organized to organized. And we feel this will still deliver a very good double-digit growth opportunity for us in the coming 5 years. At the surface, those are two levels. If I had to think of the last 3 to 4 years, a lot of our growth was driven on the ATM side. If I had to think forward in the next 3 to 5 years, we feel a lot of our growth will come from two specific areas. Retail,
yes.
Which itself has its own churn. We saw e-commerce leapfrog during COVID. Post-COVID is sort of stabilized, and we see back organized retail back in flow.
Yeah.
And any large retail chain is looking to expand their network. And the second is our new technology business, our AIoT remote monitoring business. I think these two will lead in terms of growth rates.
What I wanted to ask you about is your market share. You have majority of the market share, whether you look at the ATM side or the retail side or CIT as well. Do you see market share increasing from year on? Because I think in the last couple of years, you've increased your market share by close to 500 basis points or so. Is there a further scope for you to go ahead and increase market share, become more dominant?
So I wouldn't think in terms of dominance, I would think in terms of impact, right? And again, growth, delivering value to customers is your goal. And that may lead to market share, and it may lead to market share growth. Our market share in the cash logistics business, where we are the incumbent leader, has grown to almost 40% of revenue. Yeah. I don't think this is dominant. I think 60-70% becomes dominant. I think we still have a lot of scope for growth.
Do you intend to go to that 60% or?
Well, we would aspire to get to there. Of course, we would aspire to get to that number. And again, why do we think that's a good number for? It may happen in the mid or the long term, I don't know. But if you think of this sector specifically globally, this is a logistics business. A logistics business renders itself to network and reach, which you already have put in place. It also renders itself to risk management. And therefore, if you look at large countries, you look at the Americas, you look at Europe, you look at Latin America, it's usually a 2 or 3 player sector. However, India has seen very high growth. Yeah. So, if you asked me 10 years ago, there were 4 players. 6 years ago, there were 10 players. Today, we have 4 to 5 players. Will this increase or reduce? I don't know. But I would say that over time, we should mimic the global market. This should become a 3-player market. In a 3-player market, we would hope our market share is more than 50%.
Let's talk about both your verticals, the cash logistics part of the business and the managed services as well. Now, clearly, we've seen the managed services grow at a faster clip. The smaller part of your business, I think it was in mid-teens, which contributes close to around 30% now. So tell us, how do you see both these two verticals grow? And what would an ideal mix look like between the two? It's currently 70-30 odd.
So, let me answer the last part quickly. I don't think there's an ideal mix really, and it's very difficult to forecast that. But I'll tell you how these businesses are. Managed services, 0% of revenue in FY14, today is 34%. Cash logistics, which in 2009 was 25%, moved to 100%, is now down to 64% or 65%. In the next 2 to 3 years, basis current momentum, order wins, we think the managed services overall business would be close to 40% of our business, give or take 1% here or there. And therefore, cash logistics would be 60%, assuming we don't have any new verticals or we don't acquire anything else. So I think 60-40 is the way where I think this is heading to in the, I don't know whether you call it short term, but I think the next 2 to 3 years. Over the next 5 to 6 years, obviously, I think the contribution of cash logistics business would come below 60% to 55, 58% or so.
Well, Rajiv, you mentioned that, retail and AIoT, both of them could be the drivers from here on.
Sure.
Now, AIoT, quite impressive. Revenue is already at around 100 crores odd, but tremendous scope of growth. Where do you see this number headed? And also, if you could just brief us about the margin difference between your business and AIoT. Is it relatively lower?
So, our software businesses, which includes AIoT. AIoT is a business we incubated 2.5 years ago. And I remember at IPO time, I told investors, you're getting an option value. It's zero revenue, but amount of money we are investing, and the conviction we have, this could become a sizable contribution to us going forward. These businesses are quasi-SaaS and actually get, almost valued on a revenue multiple. However, that's not our goal right now. The business is running right now at ARR of 100 crores. Strong margins, 100 crores. We made a very small investment acquisition for this company. I think organically this business should should at least double in the next 3 years, organically. And I say organically because this is still a very vast space and opportunity. We are focused primarily on the BFSI vertical right now.
Yes.
But as we find opportunities for growth into logistics, retail, telecom, we don't know which one will materialize, there could be substantial growth opportunities. For a contribution perspective, our software business and AIoT business was close to 4% of revenue last year, should get to 8% of revenue by FY25. and I hope 10% of our revenue by FY27. This is a business which is zero, again, as I said a few years ago. Margin profile for us, it varies across businesses. Some have capital intensity, and AIoT business, as you can make out, is very technology investment dependent. But it till now has delivered very strong margin profiles. We don't break out margin profiles by sector, but broadly, if you see our cash management business and managed services business, I think they're both operating at a 26-28% EBITDA margin.
You briefly mentioned about this AIoT could get a multiple on sales.
It should be.
Do you think at some point of time there could be some further unlocking of value just in this segment if it goes from 0 to 100, and then from 100 you're talking about it go to roughly around 300, 350 crores in the next 4 years or so? Is there a potential to unlock value in this particular segment?
I strongly personally believe in it, and I say that, but for that we'll have to first prove it. We'll have to first scale the business to that level so that this can become an independent business by itself.
What is that level you're looking at?
So, there are two elements we think today. One, we think we need to broaden our horizons from just BFSI. If we are able to make this a horizontal play, then we could argue that this should be housed in a different business, right? It doesn't have to be within CMS Info. If we are able to take this business outside the country successfully over the coming 3 to 4 years, that will be the next driver. And third will be revenue, right? If this becomes a 400-500 crore revenue potential, we don't have to wait till then, but if you can see that happening, then in my mind, this should be something which could sustain itself on its own. So again, this is the future. We don't know which direction we'll take. As of now, this is a core part of our business because we serve banks with it. It's very well integrated with our offerings. But we are looking to invest in technology to see how we can branch out and do broader work here.
What about the overall business? 1,900 crores is what you've done. You have been growing at a fast clip. But you have your sights on 2,500 crores in the next couple of years. That's 2025. And 2027, you're looking at around 3,500 crores. Could you tell us, is there an inorganic plan as well in here?
So, the FY25 guidance we gave was 25 to 2,700 crores. As of now, we seem to be in track to be in that range. And that's good growth. If you look at our last 2 years, we've grown revenue at 20% each year. If you look at our last 4 years, we have grown revenue more than 20% 3 out of 4 years, other than the year of COVID. The next 2 years, if we are able to maintain our growth rate to hit the number we talked about, I think we are in good shape from a FY27 perspective. Having said that, I do want to reiterate, we haven't given a guidance for FY27.
That's an aspiration.
34 to 38 is an aspiration. We don't know where we land, but we also told investors at the end of this year, we'll come back and give a more closer, a better guidance for that year. I would think that 80 to 90% of the revenue in FY27 should come from organic sources. We want to keep some luxury to be able to invest into expansion areas. As a team, we have done 7 M&A transactions, but most of them have been very small. We don't buy growth. Our focus on M&A is really to expand into new skill sets and new sectors. And then we like to scale ourselves.
At current reckoning, with the near-term target, 25 to 2,700, will you be leaning more towards 2,700 than 2,500?
It's just too...
Come on, Rajiv, give us a number.
I would hope to...
Do you want to go bang in the middle?
I think we would be more conservative and stick to the middle because that's exactly double of our growth number from FY21. I think it'll be a good number to achieve. If we can grow 2x in 4 years, we'll be very happy.
You're sitting on good amount of cash, but what about your capex plans? On a per annum basis, what is it likely to look at? You're generating fair amount of operating cash flows as well. But capex plans for the next few years?
So, last 2 years, we invested about 210 crores in each year. Thankfully, our ROEs have expanded, which is remarkable. So therefore, that shows you the discipline of our capital allocation. We forecast, again, this depends on growth opportunity. We forecast that for the next 2 years, our capital requirements would be in the 150 to 200 crores range. We're lucky that the way we are delivering our business right now and executing, we are generating cash flows. That remains a core part of the business model. In a network density business like ours, if you're doing the right thing in expansion, gaining market share, these become very good cash flow generative businesses. So yes, we hope to aspire to repeat what we've done in the past in the coming years.
All right. Well, Rajiv, the growth trajectory looks very, very good. But what about margins? You've moved margins from late teens to late 20s. Do you think 30% is on the cards because you'll have operating leverage that will play out, as well as route optimization? Is that an aspiration as well?
It's almost impossible to forecast margins. I wish we could. Inflation, business mix, and whatnot. The way we think of it is if we can drive high revenue growth and high customer impact, with a focus on market share. Margins is a direct corollary of that. Today, our margin profile is amongst the best in the world, best in India. It's fairly world-class. We don't have aspirational margin target. Of course, we'd like to maintain this margin profile. There has been a substantial improvement in margins over the last 4 to 5 years. And if this consolidates, I'd be very happy. But our focus will remain on high revenue growth and market share, and maintaining margin profile as close as we can to current levels.
Okay, well, what about the current promoter, the PE investor? They've been gradually selling stake in the open market. Do they have any plans to further trim down their stake in this year, in this fiscal year?
Well, I want to clarify this. Our promoter is actually a financial investor. It's Bearing Asia. It's a large PE fund who has a subsidiary called Scion, which holds shares in CMS. As any financial investor, they will exit over a period of time. They have been investors in CMS for 8 years.
Yeah.
And in fact, it's funny you asked me this question at an investor meeting this year in May. People said, well, their large stake of 61, 62% is overhang on the stock. And I said, well, I think over a period of time, this will go down to zero, logically. I'm surprised and happy to see that it's gone down from 61 to 27% in the last 3 months or 4 months. So logical to assume this will go down. Their fund life is another 2 to 4 years. I am at no liberty to know their plans of timing of exit. But for investors of CMS, for potential investors of CMS, what I want to underline is you have a professional management team with skin in the game who has been here together for 14 years. We've had very strong governance at the board level for more than a decade. We've had big 4 auditors for the entire journey I've been here. And I think that we have run this fairly independently with direction and guidance and governance from the board, whether it was when the company was owned by Blackstone or the company has been majorly owned by Bearing.
Yeah.
And hopefully that has given us enough experience to be able to take this company forward.
Well, so your role, Pankaj, Ankush, Manjunath, all of you all have been there for the last 14 years, so it becomes even more important from here on. Final question before we let you go. Well, there's a provision for impairment of bad and doubtful debts. And that number is, if I take a summation of it, it's really around 95 crores approximately, which forms around 5% of your total revenues in the past year. Explain this to us, and do you see this number gradually come down?
So, I say this to many people. While we are in the cash logistics business, we are also in the risk management business. Banks trust us for our quality, our network, and our net worth. The 5% number which you're referring to, and we've been talking about this on most of our quarterly calls, is the cost of doing business. We are relentlessly focused on this number. And over time, yes, this number should go down. But having said that, I think the way the market is, the processes are, the customers we serve, it's a cost of doing business. In fact, we think it's a competitive advantage. What we end up writing off or recognizing or providing for is 25% of the revenue of our next competitor. So it's a fairly large number, and I don't know how many companies can afford to do it. Do we like it? No. But do we understand this is cost of doing business? Yes. There are important process changes coming up in the market, which I hope will help us reduce this number in the next 3 years.
Well, it's been a pleasure talking to you, Rajiv. Wishing you and the team all the best.
Thank you, Nigel. Thank you so much.
All right, that was a deep dive into CMS Info Systems, but time to slip into a short break. We'll come back with another interesting stock. Voltamp Transformers will be in the Swotlight segment.